Every monetary union tends to die the same way, not with a dramatic vote or a flag coming down, but with a small number on a trader's screen quietly spinning out of control. In the late 2000s, Europe's leaders were celebrating what they thought was the end of financial history. 19 countries, one currency, one central bank, one great political project that was supposed to turn a continent of rival states into a single economic power. A Greek government bond, an Italian bond, a Spanish bond, they all traded at almost the same interest rate as Germany's. Same money, same rates, same apparent risk. The dream was that centuries of conflict would be replaced by a single, stable financial heartbeat. And then, almost overnight, that heartbeat began to split. Starting in 2009, the yield on Greek 10-year government bonds didn't just drift a little higher, it spiked. The gap between Greek and German borrowing costs, the spread, exploded from a few tenths of a percent to multiple percentage points, then into double digits. Within a short space of time, debt that had been treated as safe enough for pension funds suddenly looked radioactive. A line on a chart turned into an existential crisis for an entire continent. This is where the story really begins, because that number, that spread, wasn't just about Greece. It was about what happens when a union built on shared money collides with fractured trust. On the surface, a bond spread is dull. It is just the difference between what one government has to pay to borrow money and what another government pays. Two interest rates, one minus the other. But in a monetary union, that difference is a verdict. It's the market's way of saying, this government is trusted, that one is not. This country can be rescued, that one is expendable. It takes a project that calls itself a union and turns it into a hierarchy. To understand how a few basis points rewrote European politics, it helps to rewind, back to when everyone convinced themselves that risk had been abolished. When the euro was launched in 1999, it was sold as the final step in a long journey. After the disaster of 2 world wars and decades of currency chaos, Europe would share one money. Inflation would be tamed, trade would boom, interest rates would fall. The weaker economies would converge with the stronger ones. If everyone shared the same currency and the same central bank, the logic went, then everyone would eventually get German-style stability. Before the euro, reality looked very different. Italian, Spanish, and Greek bonds had to pay much higher interest than German bunds. Investors remembered inflation, they remembered devaluations, they remembered governments that preferred the printing press to tax reform. So they demanded a premium. That premium, that spread, was a warning light that never switched off. After the euro, the light went dark. Once the common currency arrived, spreads collapsed. Investors assumed, or pretended to assume, that if push ever came to shove, no Eurozone government would be allowed to default. The European Central Bank would quietly stand behind everyone. German credibility would magically stretch all the way to Athens, Lisbon, and Madrid. A Greek bond might not be exactly the same as a German one, but it was close enough that the difference barely mattered. The message from the market was intoxicating. Congratulations, you're all German now. Cheap money did what cheap money always does. It encouraged denial. Governments that had once been punished for running large deficits could now issue debt at historically low rates. Banks in the core, in Germany, France, the Netherlands, shoveled loans into the south, buying periphery bonds and financing construction booms. Households in Spain and Ireland went on a building spree. Politicians in Greece discovered that they could finance generous public services and patronage networks at interest rates their predecessors would never have dreamed of. The euro didn't erase differences. It covered them with a fresh coat of paint. Some countries used the window to reform, to cut deficits and restructure economies. Others used it to postpone difficult choices. But the spread, that small number that had once screamed danger, fell asleep. Markets priced everything as if default inside the Eurozone was impossible by definition, as if the rules of finance had been rewritten by treaty. Then, in late 2009, the illusion cracked. A new Greek government opened the books and admitted what many had suspected. The deficit numbers were fake. The debt was larger than reported. The state had been borrowing heavily to preserve the appearance of normality. Suddenly, the assumption that everyone in the Eurozone shared the same level of risk looked less like integration and more like wishful thinking. The spread woke up, and the verdict was vicious. Greek yields surged. Investors who had once treated Greek bonds as just another piece of European paper now demanded an enormous premium. But the panic didn't stop in Greece. As soon as one country's numbers were exposed, suspicion moved on. What about Portugal? What about Ireland, with its swollen banking sector? What about Spain's property bubble? What about Italy's towering public debt? The crisis did not spread by vague fear. It spreads by spreadsheet. Investors began asking basic questions that had been ignored for a decade. How much does this government really owe? How productive is this economy? How much tax actually gets collected? What happens when growth slows? The answers weren't comforting. Spreads versus German bunds turned into jagged cliffs on every chart. 200 basis points, 400, 600, and more. Each step higher meant it was more expensive for a country to roll over its existing debt. That higher cost made default more likely. The greater the default risk, the higher the spread. It was a self-feeding loop, visible in real time. In a normal country with its own currency, there is an escape valve. When investors lose confidence, the currency falls, exports become cheaper, inflation rises. Painful, yes, but familiar. The tension is relieved through the exchange rate. Inside the euro, that route was blocked. There was no drachma to devalue, no peseta to throw overboard, no lira to sacrifice. There was only the euro. If the currency couldn't move, something else had to. Wages, pensions, public spending, house prices. The euro acted like a modern gold standard, and the bond spread was the lever that enforced discipline. As spreads widened, the question hanging over trading floors and cabinet tables was no longer just, will Greece pay? It was, is this union actually irreversible? The treaties said yes. The charts whispered no. For the first time, markets began to price something they had been told did not exist: redenomination risk. The possibility that a bond issued in euros might one day be repaid in a resurrected national currency instead. Maybe a Greek bond was secretly a future drachma bond. Maybe an Italian bond was a lira in disguise. The spread now contained more than credit risk. It contained the chance that the entire project would break. Meanwhile, the bond market quietly redrew the map of Europe. Core countries like Germany, the Netherlands, and Finland could borrow at record low rates, sometimes even at negative yields. Investors ran toward them as safe havens. Periphery countries were pushed into a corner with soaring borrowing costs. On paper, they all used the same money, carried the same notes in their pockets, and faced the same central bank. In practice, there were two different Europes, separated by a set of numbers on a Bloomberg terminal: north and south, core and periphery, creditor and debtor. The spread had drawn a border that no politician had voted for. The official response arrived in the form of hurried meetings, late-night summits, and acronyms. In 2010, Greece received its first bailout package from its European partners in the IMF. The deal came with strings: tax hikes, spending cuts, privatizations, reforms. This was presented as solidarity, loans from richer countries to help a weaker partner, but it came tied to a specific story. The crisis, the narrative went, was the result of national irresponsibility. The medicine had to be austerity. Soon, Ireland and Portugal followed with their own programs. Temporary rescue funds like the European Financial Stability Facility were created, then a permanent mechanism, the European Stability Mechanism. Each was supposed to reassure markets that there was a fire break. If one country burned, the flames would be contained. On the ground, it looked different. In Greece and Spain, unemployment soared past 25%. Youth unemployment climbed over 50%. Small businesses closed. Public services were cut. Hospitals struggled. A generation of young Europeans packed their bags and left. In the north, newspapers printed stories about lazy Southerners who had lived beyond their means. In the south, people marched with banners comparing European officials to occupying powers. The same bond spread that traders watched on screens translated into closed shops and boarded-up homes. The numbers became personal. The crisis brought down governments. In Greece, prime ministers resigned, elections were reshuffled, and new parties surged by promising to defy the conditions tied to the bailouts. In Italy, a technocratic government was installed with the explicit backing of European institutions, in large part to reassure markets that someone serious was safeguarding the budget. Democracy continued, but always under the shadow of the spread. The message was clear: you can choose your leaders, but only within the range that keeps investors calm. And then, in the summer of 2012, with spreads on Spanish and Italian bonds climbing again, and analysts openly discussing how the euro could fall apart, 9 words changed the trajectory of the crisis. Within our mandate, the ECB is ready to do whatever it takes to preserve the euro. Behind those words was a new instrument, the promise of potentially unlimited bond purchases for countries that agreed to certain conditions. The central bank was saying, in plain language, that it would not allow the market to simply push a member state out of the union by driving its borrowing costs through the roof. Something remarkable happened. Spreads started to fall before a single bond was bought. The words were enough. Investors believed that the central bank would, if necessary, stand in front of the panic. The nightmare scenario, a chain reaction of defaults and exits, was pushed back. On the surface, this looked like a victory for unity. The center had held. Underneath, the balance of power had shifted. From that moment on, every government in the Eurozone understood a new reality. Survival did not just depend on winning elections or managing the economy. It depended on staying inside the lines drawn by institutions that could, at any time, let the spread rise again. A country that drifted too far from the accepted path risked discovering that markets were no longer comforted by the central bank's umbrella. The euro crisis is often told as a morality tale. On one side, disciplined northern countries that save. On the other, irresponsible southern countries that spend. Or, in a different telling, hardworking taxpayers versus greedy bankers and corrupt politicians. These stories are comforting because they turn a structural problem into a question of good and bad behavior. The less flattering truth is that the crisis was baked into the architecture. Countries gave up their own currencies. They gave up the ability to devalue, to inflate away debts, or to do a classic sovereign default and start again under a new monetary regime. But they did not create a full fiscal union to match. There was no single European treasury with the power to tax and spend across borders. There were no common Eurobonds that would pool risk completely. There were national budgets plugged into a shared currency, each one still judged separately by markets. The euro created one money, but left 19 bond markets. As long as spreads remained tiny, the contradiction could be ignored. Everyone could pretend that the risks had converged. But once those gaps opened, the design flaws flashed like warning lights. You did not need to read pages of legal text to see them. You just had to watch the distance between German yields and those of Italy, Spain, or Greece. That distance told you where the pain would fall. It told you who would be pushed into deeper austerity, whose banking system could be destabilized, and whose governments were running out of time. The bond spread acted as a kind of lie detector for the promises of the Union. The more the politics insisted that Europe was one, the more the market exposed how many Europes there really were. After years of emergency meetings, reforms, and programs, the visible crisis faded. Today, the euro still exists. Greece is still part of the club. Spreads are far below their peaks. Some former problem countries are even able to borrow at rates that would have seemed impossibly low before the euro was created. What did not return is the early illusion that all government debt under the euro is essentially the same. Investors now know that sovereign bonds inside a currency union can behave like very different animals in a storm. Citizens know, at least vaguely, that when the bond market loses patience, their pensions, wages, and public services can be suddenly renegotiated in the name of restoring confidence. A generation of Europeans associates the word reform, not with progress, but with cutbacks imposed under pressure of rising spreads. A monetary union that promised to iron out old divisions ended up drawing new lines, softer than borders on a map, but just as real. For anyone watching, the lesson is simple and uncomfortable. Currencies, unions, fiscal compacts, they are all stories about trust. Treaties declare that something is irreversible. Leaders say that whatever it takes will be done, but trust is not written in law. It is written in behavior and belief. And bond spreads are where those beliefs are priced, second by second. When a leader tells you that the markets are overreacting, what they are really saying is that the scoreboard is showing a result they done tea-like. When you see a chart of spreads suddenly moving apart, what you're seeing is the edge of a promise. The point where investors begin to doubt that tomorrow, as rules will match yesterday's assurances. That is not just a European story. It is how any system built on shared money and separate politics is tested. Whether it's a union of states, a federation, or a block of countries tied together by treaties, the questions are always the same. Who guarantees whom? Who gets rescued first? Who can be sacrificed? The answers show up in the spread before they show up in speeches. Every crisis reveals what a union really is. Not the slogans, not the flag. The pattern of who pays, who is protected, and who is forced to adjust. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.